Good afternoon, everyone. Thank you for joining us for today's National Conference of State Legislators webinar, COVID-19, Mortgage and Foreclosure Issues. My name is Representative Matt Lehman. I'm the co-chair of the NCSL Communications, Financial Services, and Interstate Commerce Committee, and I'll be your moderator for today. This is the first in a CFI Committee COVID-19 webinar series. We have a total of 3 webinars lined up, including a discussion on consumer lending, credit reporting, and consumer data in the age of COVID-19. For a complete schedule and registration details, please visit our website, www.ncsl.org. Before I introduce our speakers, I want to review a couple of housekeeping items. Today's webinar is a platform for information exchange and engagement. Over the next 60 minutes, we encourage participation through our chat box, so feel free to type your questions and answer any questions in the chat box on your screen. To begin building some comfort with the chat function and also learn who is on the line today, I invite you to type in the state from which you are calling now. We will hold a formal question and answer after all our presenters are finished presenting. Many of you will want to download the slides from today's webinar. You can find a PDF version of the slides by opening the tab labeled Resources. The tabs are found just above the presentation window. Another tab is labeled Speaker, where you can read the bios of today's speakers. You can access these tabs at any time during the presentation. If you have trouble downloading the presentation, please email Heather Morton, our CFI committee staff, at heather.morton@ncsl.org, and she will be happy to send you the deck of slides. The webinar platform we're using is optimized for use in Google Chrome. We recommend anyone experiencing technical difficulties try signing in through Chrome. If you continue to experience technical issues, please email registration@ncsl.org and where NCSL, where our team is ready to assist you. Today's webinar is being recorded and will be available on NCSL's website within a week. So, the National Organization of State Legislators is a bipartisan organization that serves the legislators, legislative staff of the states, commonwealths, and territories. NCSL provides research, technical assistance, and opportunities for policymakers to exchange ideas on the most pressing state issues and is an effective and respected advocate for the interest of the states in the American federal system. NCSL developed a web page to house our comprehensive resources on the state and federal response to COVID-19. Here you can find a database with up-to-date, real-time information about bills related to and responding to COVID-19 that have been introduced into 50 states, Puerto Rico, Guam, and the District of Columbia. Archives of previous webinars, information on state policies, and response related to continuity of government and other important considerations during this unprecedented time. Now that the housekeeping details are out of the way, let's get back to why we're on the call today. New census survey data shows that nearly 1/4 of adults are experiencing housing insecurity because they either missed their rent or mortgage payment in May and June or have little or no confidence in their ability to make their next housing payment due to the loss of employment income. Are there lessons to be learned from the 2009 recession and foreclosure crisis? This webinar will discuss how states are responding to mortgage and foreclosure issues related to the COVID-19 pandemic. We have a great panel today. Joining us are Rod Alba, Senior Vice President, Mortgage Finance and Regulatory Counsel, American Bankers Association, Jeff Walsh, Staff Attorney for the National Consumer Law Center, and Mike Shank, Deputy Chief Advocacy Officer and Chief Economist, America's Credit Unions. First up, we have Rod Alba, who is Senior Vice President and Senior Regulatory Counsel at ABA's Mortgage Markets, Financial Management, and Public Policy Department. Rod will briefly describe what is and what is not in the Federal Coronavirus Aid, Relief, and Economic Security, CARES Act, and banking industry response. Rod, thank you so much for joining us today. The floor is now yours.
Well, thank you very much. I trust that you can hear me. I appreciate that introduction. I commend the NCSL for organizing this panel because it opens up not only information and description of our experience in the trenches, if you will, but it also gives us a venue to discuss these issues further. This is a serious pandemic affecting our nation. It is having an impact on the public, and we really need to have an exchange on what is working, why, how we can improve. That last element, how we can improve, is always an important issue on the table. We have our doors open, our windows open, everything open to understand from all of you what is affecting you, what's affecting you at the local level, and how we can better serve the public as America's banks. The issue of forbearance and assistance to borrowers is crucial, not only because it provides safety from financial catastrophe for many borrowers, but it is really a broader source of assistance to struggling families. So if you lost your job and you cannot repay your loan, well, the forbearance will offer you a lifeline and protection from foreclosure. That's true. But if you're just affected and you need some oxygen, the forbearance programs that the industry, that the mortgage lending industry and the mortgage servicing industry have put out, if you're affected and you just need this oxygen, it does that as well. So this is a robust relief lever for the American public. And our banks and our financial institutions accept that responsibility. We are conscious of how crucial this is to our nation during this pandemic. I also want to start off with the important statement that the forbearance process is working pretty well. It is simply unprecedented to roll 4 to 5 million homeowners from a sort of normal payment status into a forbearance status, into a crisis management status in a period really of 3 to 4 months. Usually you need months and months to organize compliance and other programs to engage in this type of switchover. But, with the very conscientious work of policymakers, program experts, legislators, devoted teams of lawyers, bank employees working really weekends, days and nights, we're getting it done, and it is rolling, and I will say cautiously, it is rolling smoothly. The Mortgage Bankers Association, their latest forbearance survey reports that this week the loans in forbearance, and I'm looking at my notes here, have decreased by 8 basis points to 8.39%. So that came down from last week, which the numbers were at 8.7%. They have now come down to 8.39. This is the third straight decrease, third week of decreases as we're watching over these numbers. The MBA, the mortgage bankers, they estimate that currently 4.2 million homeowners are in forbearance plans. The share in Fannie Mae and Freddie Mac loans in forbearance is at 6.17%. The share in Ginnie Mae loans, and this means FHA loans, I guess you may consider them to be less than prime loans very often. They decreased by 11 basis points to 11.72%. And in portfolios, we're seeing that they are at 10%. So, this is an ongoing issue, but we have seen numbers improving. And I just want to say that the immediate sort of explosion and surge in forbearance needs that we had at the beginning of February and March, and handling these things at the drop of a dime, and the ability to manage through this was unprecedented. It has been my most intense professional period, and I went through the meltdown of 2008. This has been worse simply because of the suddenness and the time periods that are so constricted. We have to act. We have to act now. We have to roll out the relief to our borrowers and to the American public that has been very, very intense. This is why this conversation is so important. So let's go right to the beginning. If you go to that first slide, I think that I just want to begin the ABA perspectives, the banker's perspective, by noting that the mortgage servicing industry was among the first segments to really recognize the problem and begin to act all the way back in January and February is when we started our meetings. And when the news of infection started, when we understood the depth and the severity of the potential consequences of COVID, we got right to work. In the first slide, you will note and you will see a description of our immediate attention to the problem. A big swath of the financial services industry, including banks, depositories, also independent mortgage bankers, servicers, everyone got together for only one purpose: to determine how we could quickly and immediately set up programs to help the public and roll out relief that we knew would be in very high demand. So the goal was to craft a set of approaches and standards that we could all agree to. The objective is quick and efficient response to the huge numbers, what we knew would be huge numbers of affected households, and do this with uniform programs that were simple and streamlined. It had to be easy for consumers. No big paperwork, no hesitations, no back and forth with the customer about what do you need, when do you need it, how do you need it, please show me some paperwork. None of that. We had to cut all that out. The mortgage industry committed to ensuring that households in need received help immediately. And this was, the methodology was payment forbearances that could extend from 90 days to 12 months. Basically, a payment vacation that would have no impact to the consumer other than stop paying. The assistance would then be followed by an appropriate loan modification. Programs would be set up that would allow consumers to simply resume their previous mortgage payments without additional costs or penalties. And that would be the first and best option for most, though this had to be complemented by other programs for perhaps some other borrowers that were in deeper trouble or that would need continued assistance. So observe that the industry came to consensus on early in March. As you see there, the letter was issued on March 22nd to policymakers in Congress and also at the state and local level. And again, the objectives: establish uniform programs and policies across government agencies, also with Fannie and Freddie, so that all affected borrowers were eligible for similar assistance. This couldn't vary across states, across regions. It had to be uniform. It had to be strong. It had to be effective. We opted to adapt and rely on existing programs and practices that were there on the books at that point for natural disasters. We did this because those were tested programs. We shouldn't be inventing this as we're flying the airplane. This is a very dangerous flight we're on. We can't be fixing the engine at that point. We had to rely on what we knew, on those programs that were on the table. We had to keep all the rules and the requirements simple and streamlined, again, for the sake of affected borrowers. And we had to also minimize future program changes. So we didn't want to come back and fix every time there was a problem, a detail. We needed to get this right the first time. So that consensus is what then eventually morphed about a week or 10 days later into the CARES Act. Now, what was happening with the CARES Act, those considerations were separate and they were looking at different issues, but certainly a lot of the principles and the elements that we had in the industry alliance draft very much correlate with what eventually becomes the CARES Act. I urge you to take a look at the industry draft because they will guide you also in various considerations and other elements that you may be thinking about in your home states, and also will help you talk to your own lenders in your communities. If you can talk their language, if you can sort of address those concerns, we can get to consensus, we can get to solutions real quick, and I'll talk a little bit more about that later. But just to get through, the CARES Act then comes in late March, and this is important because the Coronavirus Aid, Relief, and Economic Security Act establishes two very important protections for homeowners, which is the 60-day foreclosure moratorium. This began on March 18th of 2020. Again, it extended 60 days, but Fannie and Freddie and all the government agencies have extended it even further all the way out to August at this point. So the moratorium pretty much continues in force for most mortgages out there. And it also established a right to forbearance for borrowers who attest to experiencing a financial hardship. due to the COVID-19 emergency. That second bullet, we think, just deserves a little bit more attention, because the CARES Act, Congress, rather than coming in and saying, hey, American public, we're going to give you a brand new loan, a brand new loan product here that you can access so that can serve as a bridge into the post-COVID world. They didn't do that. What they said is, we're certainly going to set up assistance programs and payment programs for you. But really, what we need in terms of mortgage support and housing support is we just need to give you a break. If we can give you a break, if we can give you that vacation, we can get through this, then the forbearance program will serve as the real solution for the American public, and we need everyone to participate. And certainly, we had already formed our set of principles. We came to the table, and what the CARES Act does is it establishes that borrowers may request, and servicers, when there is a request, must offer a forbearance of mortgage payments. This applies to borrowers with federally backed mortgage loans. Now, that's very important because it covers Fannie, Freddie, it covers FHA, it covers some of the federal home loan banks. But I will tell you that it doesn't cover, therefore, portfolio loans. That is a minority of loans in the market, but all portfolio lenders, and I will assure you of this, are following these same guidelines. Even though they're not required to do so, they are following guidelines that are substantially similar. Certainly our members are following the guidelines that are set out in the CARES Act. Their programs may vary a little bit. The important point here is everyone is following these set of standards, but the federally backed mortgage loans are the ones that are required to do so under the CARES Act. Borrowers have to be experiencing a hardship that is related to COVID-19. A hardship does not mean that you're not getting paid. A hardship just means that you're suffering a hardship. There is an impact on your income. There is an impact on your family. And so long as you can assert that, then you will be afforded a COVID-19 forbearance. Borrowers are only required to request a forbearance and affirm the hardship. You're not required to provide all sorts of additional information in order to receive the forbearance. So certainly a lender, a servicer may come back and assure that indeed there is no fraud in that transaction, but as the borrower requests it, they will get the forbearance. And finally, forbearances have to be granted for 180 days, and they will be extended for an additional period of up to 180 days at the request of the borrower. Now, note, it says that the forbearance will be granted for up to 180 days. Wow, why can't we just give them 6 months, right? Why can't this program just roll out and say, consumers, you come and you ask us and we'll give you 6 months? Well, to a certain extent, that is what this legislation guarantees. However, it may not be proper. It may not be good for every consumer to go straight into 6 months forbearance. There is a need for a little bit of leeway, a little bit of play. Some consumers may understand, may not want 6 months of forbearance. A forbearance has to be repaid, so a consumer may not want to go into the hole for 6 months right away. Can we take it month by month? Can we take it for a 2-month period and see what happens after 2 months, or perhaps for a 3-month period and see what happens after 3 months? That is the conversation that should be had with the servicer, with the lender. However, the CARES Act, make no mistake about it, guarantees 6 months right at the outset and an additional 6 months should the borrower request it. And again, that is a very important part of the CARES Act. So as I said right at the beginning, we've rolled about 4+ million people, unprecedented over the past 3 to 4 months. And we think that this is going well. We have had some confusion. We've had some difficulties in terms of what are the rights, how does this work efficiently or effectively. But I think that rolling that many people into forbearance so quick provides us with perhaps a measure to raise the flag and say, it's happening, we're doing it, we are helping the American public, it has been successful. I will say, however, and this is where my conversation gets somber and gets serious, that we have to look ahead. Make no mistake about the fact that Post-forbearance, the forbearance exit stage is going to be much more difficult than just rolling people into forbearance. When you roll someone into a forbearance program, you basically ask them, how many months do you need? What is your difficulty? And then you just give them a break from the payments. Post-forbearance.
Rod, I don't want to necessarily cut you off, but we need to wrap up here. We need to move on to some other speakers. So kind of take the next half a minute here, 10 seconds really to wrap up, and we can move on to our next topic. It's been great.
Yeah.
So, Rod, any last comments?
Yeah, I'll be happy to do that. If you just look at the looking ahead, we have to look forward and look at the most difficult part of the process here, which is going to be getting consumers into post-forbearance workout loans that they can indeed repay. That is a very it's an intensive process. We're preparing for that, and we'll have time to talk about that should questions come up. But that is the process that we're engaged in now and worried about now. Thank you so much, and my apologies for taking a little too long.
No. Thank you, Rod. That was some great stuff there. So we're going to move on now. Next up, we have Jeff Walsh, who's a staff attorney at the National Consumer Law Center, who focuses on foreclosure prevention, consumer bankruptcy, other consumer credit issues. Jeff will discuss the differences between the 2009 recession and today, providing the consumer advocate perspective. Jeff, thank you so much for joining us today. The floor is now yours.
Thank you very much. And I'd just like to follow up on Rod's comments that I think from the consumer advocate's perspective, we share the sense that the basic loss mitigation options that particularly the federal agencies, FHFA, and the federal guarantee agencies have developed in a very quick time to deal with the COVID-19 crisis have generally been very well thought out. A lot of people worked very hard to get these programs set up in a very short time. And there's going to be a lot of uncertainties in terms of what happens in the future, but we certainly think that these solutions that the industry has come up with are good, reasonable estimates that are about as effective as people can think up at this present time with the knowledge that we have. The real challenge is going to be in implementing particularly some of the post-forbearance options that borrowers will be hitting over the next couple months in particular. And I think one key to understanding what some of the issues, particularly in the future, will be is this concept of a federally backed mortgage loan. That is a concept taken out of the CARES Act. It means loans that are owned or insured or guaranteed by one of the GSEs, Fannie Mae or Freddie Mac, or insured by one of the three federal insurance agencies, FHA, VA, and USDA. And as you can see from this chart, those federally backed loans, the GSEs and the federal agencies, comprise about 65% of the home mortgage loans in the country. And these are generally the loans that have been equipped with loss mitigation options, particularly targeted to the COVID-19 response, and that we think are going to be effective. And the real challenge is going to be identifying who has these loans and making sure that they're treated appropriately under the guidelines that have been set up for them. There will be similar options available for the private banks, some of the other 35%, but much of what I'll be talking about will be focused on this 65%, the federally backed loans. And as Rod mentioned, these loans are subject to common loss mitigation guidelines by the guarantee agencies that have programs for forbearance, post-forbearance relief, getting the loan reinstated. The focus is very much on streamlined applications, even making blind offers of modifications at the end of the forbearance periods, meaning that the offers of modifications can be made under these programs without any application at all to certain borrowers that are behind in payments at the end of forbearance. and there's minimal reliance on documentation, on income information from the borrowers. They're designed to work with a minimal amount of borrower contact, just because of the strain that this is going to put on the staffing in the servicers' shops. And these federal agencies, the backers of the federally backed loans, have set out a certain number of guidelines that apply to all of these loans pretty much uniformly. There are slight variations, but for example, for forbearance, the servicers of these federally backed loans must approve the forbearance if the borrowers indicate the COVID hardship. They're generally entitled to up to 12 months of forbearance. At the end of forbearance, the servicers cannot demand a lump sum repayment. One of the things that they have to be offered is the accrued arrearages. The 6 months of arrearages can be made into a non-interest-bearing lien that comes due at the end of the loan's normal repayment period, so that should avoid payment shock at the end of the forbearance. There are also guidelines in these agencies' programs for considering borrowers who can't afford to resume payments at the end of a forbearance for modifications that can make the terms permanently more affordable. And in terms of actions that states have taken to deal with borrowers facing COVID-19 mortgage hardships, I just wanted to make a couple comments about moratoria that quite a few states through governor's orders have issued moratoria on foreclosure proceedings. Some of those have expired by now. The main foreclosure moratoria for federally backed loans under the CARES Act expired in May. However, as Rod mentioned, the federally backed loans continue to be subject to a moratorium that will expire at the end of August. And many people are not aware, too, that there is a provision in the federal RESPA mortgages, the Real Estate Settlement Procedure Act guidelines, that bars the commencement of foreclosures until a borrower is 120 days or 4 months overdue. So what you basically see from these guidelines is that for the non-federally backed loans, many of these borrowers who began to fall behind in April are going to be reaching this 120-day period in August. And the other federally backed loans are going to be reaching the end of their moratoria probably in September unless that's renewed. So things are going to get much more complicated when we get into August and September. I think that's the bottom line from this. And in terms of measures other than moratoria that states have enacted, a number of states, along with particularly smaller banks and credit unions, and this is true for Michigan and New Jersey, have negotiated programs to make more uniform the application process for some of those other 35% of the loans that aren't federally backed, and they can be very helpful. A more complicated question comes up where certain state laws recently enacted are setting up substantive requirements for forbearance and post-forbearance mortgage relief. In particular, there are 3 and now 4 states that have enacted this type of legislation to date. A 4th state, Oregon, enacted some legislation last week that I just didn't get a chance to put up yet, but that's a House Bill 4204 in Oregon. And that is similar to these other 3, the Massachusetts, the D.C., and the New York laws, that essentially set up requirements for servicers under state law to implement forbearance programs that are consistent with the Federal CARES Act, but that go beyond the CARES Act and require the implementation of certain post-forbearance options, typically the offering of a non-interest-bearing lien to take the forborne payments and have them become due as a balloon payment at the end of the loan term. The Oregon and the Massachusetts statutes apply to a broad range of loans, not just federally backed loans. The D.C. and the New York laws that have recently gone into effect apply to the non-federally backed loans. They generally apply to loans that are serviced by non-bank servicers and other financial institutions that are regulated by those states. And this is going to raise some issues that I think state legislatures need to think about at this point. Are these laws going to be subject to constitutional challenges? Are there issues about potential violations of the Contracts Clause or potentially the Takings Clause in the Constitution? And I'm not going to spend a lot of time going over this, but I think it's important to keep in mind that the Contracts Clause on its face prohibits state laws from interfering with contract rights, but it's generally been interpreted to limit its effect to nullifying state laws that create what's considered a substantial impairment to contractual obligations. And even in those cases, the laws can still be upheld if they're considered a reasonable means for a state to fulfill a legitimate state purpose. And generally, there's been a fairly lenient standard to mortgage moratorium and mortgage relief laws that go back to cases decided in the 1930s that have found that these types of restrictions that limit perhaps remedies in foreclosure but do not eradicate part of the debt or waive parts of the debt that eventually preserve the lender's lien and allow foreclosure in the future, that they either don't create a substantial impairment or it's an impairment that is allowable under contract law's doctrine. And there's a similar view under the 14th Amendment Taking Clause doctrine that looks at what the lender's expectations are. Are they still going to be subject to requirements under the state law that are basically similar to what they would have to follow under their lending guidelines, under the origination guidelines, the insurance guidelines that apply to the loan? And that's probably true for these state laws that have been enacted so far. They are essentially requiring servicers, particularly the federally backed loan servicers, to comply with requirements that are set by the guarantors or the owners of their loans, by the GSEs, by FHA, by VA. And I think the state's view in these situations is that they're not requiring the lenders and servicers to do more than their own servicing guidelines require that they do anyway. There could be similar concerns raised over preemption by the National Bank Act, which basically says that nationally chartered banks can't be subject to state laws that interfere with certain activities of theirs. And the standard here is somewhat similar, that the state laws can't significantly interfere with national banks' lending powers. And that raises that same question about, well, if a state law does nothing more than require a servicer or a lender to comply with the servicing guidelines set by a federal guarantor, by the GSEs, is that really significantly interfering with their lending activities? And there are different ways that the OCC, the Office of Comptroller of the Currency, can implement these preemption restrictions on set by the National Bank Act. Generally, the OCC would have to independently examine a particular state law and make findings in an administrative process that that law is preempted by the National Banking Act. The Dodd-Frank Act held that they have to do this determination under a conflict preemption rather than a field preemption analysis, so that they can't simply say that there are entire fields of activity that states are barred from regulating lending institutions in. And similarly, in a court challenge, there are a lot of undecided questions about who can actually bring challenges to a state law affecting mortgage lending, particularly whether these laws apply just to originators, whether they apply to assignees, or whether they apply to servicers. The case law is very much in disarray on these particular questions. But I would just like to finish by referring to a few areas where I think state laws can take action to protect borrowers in the pandemic environment and at the same time minimize the likelihood that there will be conflicts either constitutionally or under federal banking law preemption. And I think that these three areas are the most amenable to this type of state action. The first would be to the extent that the state laws focus on requiring transparency in this evaluation for loss mitigation options, that they assist borrowers in identifying which type of loan they have and what the long-term reinstatement options are for that particular loan. In other words, they're not setting new substantive requirements for the loan, but they are ensuring that these transitions take place in a transparent environment. And often states have authority under their unfair and deceptive practices statutes to regulate unfair conduct or deceptive conduct. They can require accurate disclosures or prohibit misleading disclosures or non-disclosure of important information to borrowers. And finally, states traditionally have authority to regulate foreclosures of property located in their states, and that authority can typically extend to things like requiring conferences and mediation and dispute resolution in the context of foreclosures, where potential disputes about what the appropriate COVID-19 guidelines are can be addressed under some type of court or administrative agency supervision. So I think these are areas where states likely have the most leeway to exercise authority and protect borrowers, and at the same time not interfere substantially with the federal lending activity. They can be consistent with the federal guidelines. And I just wanted to mention that we have some analysis of these various state laws and some of the particular guidelines that apply to different types of loans listed on our website at this reference here. So I will conclude there and turn it over to the next speaker.
All right, thank you, Jeff, for your presentation. If it has prompted questions, again, just a reminder briefly that in the audience chat to send your questions. We'll try to wrap up here, so we do got a little bit of time left for questions. And our last final presentation here is Mike Schenk, Deputy Chief Advocacy Officer and Chief Economist, America's Credit Unions. He conducts economic research and supports CUNA's public relations and advocacy efforts, and will provide the credit union perspective. Mike, I'll turn it over to you.
Thank you, Representative Lehman, and thank you for joining the call, everybody. Whenever I talk to credit unions these days, they say, please, 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 if you're talking to policymakers, let them know how much we appreciate what they've done for us. Please thank them. The size and the magnitude of the bipartisan policy response at both the national and state level has been incredibly helpful, not only for financial institutions, but most especially for the average working Americans that they serve. So thank you for that. Just wanted to take a couple minutes, not so much to give you CUNA's point of view necessarily, although this is CUNA's point of view, but I think it's more broadly kind of a 60,000-foot look at what I feel like matters when we're talking about mortgages and the mortgage market, foreclosure issues, and housing security. So just a couple of things. I'm not going to spend a lot of time talking about this, but I think everybody recognizes this is headed in the wrong direction. This is data that shows the number of confirmed COVID cases in the United States, I just wanted to flash this up here to remind you that this is not the curve that we're trying to flatten. This is the curve that needs to be declining in order for the curve to flatten. And as we all know, this is the national view showing that indeed the curve is not declining. That's a really big deal, and I think it's a big deal from a policy perspective because the idea that this curve would be declining by mid-year is basically an assumption that underlines most of the policy response, that underlines almost all of the economic forecasts that I'm aware of, all of the housing forecasts that I'm aware of, and anybody that's thinking of housing security, sort of what they were thinking about a month or so ago. And that assumption really does lie with the experts. Folks from the Global Virologist Network basically told us that a month or two ago, actually started saying this in March and have repeated this quite often over the course of the subsequent month or so, that really the pandemic was expected to be in the rearview mirror by mid-year. And this is, of course, not the case. Here's a picture from, I guess this is Coney Island 2 days ago, or over the weekend on July 4th. This could really be anywhere USA from my perspective. If you go to Google and you type in your state, more than likely, and type in the name of your state and the 4th of July party, you're more than likely going to uncover something that looks maybe like this. Maybe it's not at a beach, maybe it's poolside. This is a big deal because what it suggests is that curve that's supposed to be declining is more than likely going to continue, at least for the next month or so, to increase and not decline. And this pushes the extent of the crisis out further into time and, of course, creates a lot of problems for the policies that have already been put into place. So that's sort of my starting point. And then the really important connection to that, of course, is what's happening in the job market. The graphic that I showed you in my first slide suggests that the purple line here, and this is a picture of job market declines associated with the last 9 recessions. So I go all the way back to the beginning of time, which I define as the year I was born, and you can see there's 9 recessions here and subsequent job market declines and recoveries. There's a couple things I want to draw your attention to. The purple line represents what we're going through at the moment, and if you believe the graphic that I showed you in that first slide, more than likely that purple line is going to go back down over the course of the next several months, and that's going to be a really big deal for a lot of consumers. A couple other things that I want to draw your attention to. Number one, that if you look at the last 4 recessions, all of them took well over 2 years to reflect a job market recovery. The recession that was the shortest occurred in the early 1980s, the first part of the double dip recession in the early 1980s, where we had a 6-month recession and a job market that declined by a little bit over a percentage point, but took a year to get back to pre-recession levels. And you can see that the last 4 recessions, again, took at least 2 years for the job market recovery to be fully obvious. So this is my point of reference. I don't feel like our baseline forecast is going to reflect anything. And when I get off of this call, we're going to meet to reformulate our forecast. Our baseline forecast is not going to call for the job market to recover at any point over the next 18 months in a really significant way. And so we believe at the end of 2021, the unemployment rate will be in the neighborhood of 8%, roughly double what it was going into the crisis. So this is really, really important from a bunch of different perspectives, not just from the perspective of the mortgage market, of course, but we do know, we have academic research that shows that whenever something like this happens, there are long-term and significant measurable changes that occur and that we all need to be concerned about. We know that whenever something like this happens, financial health deteriorates and deteriorates in a very significant way. Not surprisingly, physical health deteriorates, mental health deteriorates, substance abuse increases, domestic violence increases, crime increases, and so on and so forth. So we believe that the job effects, the employment effects related to the current crisis will be much longer lasting than most people seem to believe, number one. And number two, that those long-lasting effects will be obvious for a very significant period of time. It took about 10 years in the last several recessions for income and wealth to rebound in the wake of the recessions that we suffered through. So this is a really important starting point. Now, part of the reason that we think that this is going to be an especially long affair has to do with the nature of the employment market in the United States. There are roughly 8 million business establishments in total. 75% of the business establishments in the United States employ fewer than 10 full-time equivalent employees. According to Moody's, there are roughly 1 million of the 8 million establishments in the United States are at high risk of not reopening in the wake of the crisis, ever. There's further evidence in the Federal Reserve's Beige Book, published several weeks ago now, in which Federal Reserve researchers outline the reasons that they think that the jobs market recovery will be a longer lasting affair than is commonly believed. In the interviews that they conduct with the average consumers, they find that folks are very concerned about their personal safety, that rich unemployment benefits will delay the recovery, and that many people are very concerned about child care. So this is why we think things are going to take a little bit longer than what people typically anticipate. And I'm going to skip over the next several slides and just go to the bottom line of my presentation. We believe, based on that high-level data that I just showed you, that the recovery will take longer, as I said, than most people expected. And because of this, we think that the policy responses, while they have been extremely effective and very helpful, actually represent a bit of a disconnect at the moment given the current course of the crisis. And by that we mean that in many cases, the actual help that consumers will be needed further out than the CARES Act, for instance, anticipates. And so we have a disconnect in the CARES Act, sections 4022 and 4013, where essentially the help ends at the end of this year, or when the crisis is over, whichever occurs first. But in reality, when the rubber hits where the rubber hits the ground, we are going to really be needing the help in 2021, not necessarily simply in 2020. And so we are urging lawmakers to look at ways in which they can correct that and align the help that's given with the help that's going to be needed from a timing perspective. So I know that we're running out of time. We want to take some questions. So I will pause there and welcome any questions that you might.
All right. Well, thank you, Mike, for your presentation there. We do have a few minutes left for some questions. There's been a few submitted. I've got a couple here that just out of the conversation I've jotted down or have come up, and one would be, and maybe this is to you, Rod, on borrowers in the forbearance. Is there people looking at other options like a refinance or things like that during the short term, and maybe clarify when you talked about no penalty to their credit, is that meaning these are not being reported to credit bureaus, et cetera? So if you maybe just a minute or two touch on that, and then I've got a couple other ones to maybe gear towards Jeff or Mike.
So thank you. The credit reporting question is a very important one. It's probably what we get the most questions on, so be prepared for that. It is complex because the CARES Act does protect the consumer in terms of hits to the credit report. The consumer cannot be punished either with fees and additional costs relating to the forbearance and the arrangement, but they cannot be punished with bad credit reporting for purposes of the forbearance. So if the consumer went in with a bad credit report, this does not fix. A forbearance will not fix will not give them a good credit report. However, the opposite is also true. There can be no negative reporting on the forbearances that are granted under the CARES Act. Please be aware that once you get a forbearance, please be aware of this. For underwriting purposes, lenders down the line, in other words, after the forbearance is over, can see and can look at the fact that there were payments interruptions in the consumer's history. That is an underwriting issue. It is not a credit reporting issue. So please be aware that someone who's gone into a forbearance may be denied a loan for 1 or 2 years after. I think that the GSEs have now said that to the extent that you make payments for a period of 2 years, then they will allow you to move forth as usual. But that is an underwriting issue. I think that was the question. Was there another question in there? Oh, about refinances.
No.
Yeah. Look,
yeah.
Yeah.
No, go ahead. Are any banks doing that? Moving towards a loan refinance versus a forbearance?
Absolutely. That can be an option. It is an option to the extent that a refinance lowers your payment, puts you, the consumer, into a better position, avoids the forbearance option. It is something that is available to consumers. But, the lender, the advisor has to talk directly to the consumer and understand and make the consumer understand that the right to forbearance under the CARES Act is so powerful. It carries a lot of benefits to consumers that really you should be looking at that option just to make sure that you have made your calculations correctly in terms of what's happening with this pandemic.
All right, thank you, Rod. I'm gonna throw this one to maybe Jeff, and then Mike, you give me comments. I think you ended, Mike, in your presentation talking about some statutory changes. As a legislator, I know there's a lot of pressure on us to fix some of these problems, and so we're getting a lot of people that'll say, hey, you need to make a law that does this or this when it comes to the borrowers, to the banks, as we're facing this COVID-19 issue and others. Are there things that would clearly be maybe inappropriate for states to enact, or preemption, or on constitutional grounds? Are you seeing any action in some states that give you pause? We'll start with you, Jeff.
Yeah, I think the main thing to keep in mind is that state requirements that would mandate some particular type of modification of a loan, and by that I mean changing the interest rate, changing the amount owed, or extending the term of the loan, are probably most likely to be subject to some type of challenge. And I think it becomes a matter of what the degree is. I think you can look at something like what happened in New York recently, where the bill that passed the New York Assembly and Senate had a provision in it that waived interest that accrued during a forbearance. It would have required that waiver. And the governor had that provision stricken before it was signed into law. And I think that is that type of term in a state law that is requiring the waiver or the forgiveness of part of an indebtedness. That's the type of thing that would likely be subject to challenge, and it was probably a good idea to take that out.
And Mike, maybe building on that is as we look at different legislation issues, and that is what's a concern really from a long-term economic perspective of all of this?
Yeah, a couple things come to mind. First, we're very concerned about the disproportionate effect of the crisis on vulnerable populations in both urban and rural areas, and the effects on housing insecurity and affordability. So we're trying to nibble around the edges on that. Definitely we're concerned about state government budgets and, from a federal perspective, what more can be done to address those issues. In general, I would say from a policy perspective, what we look for and what our members, lenders, look for essentially would be policies that help with seamlessness and uninterrupted service. So helping the average consumers to the extent we can, even know these disruptions exist. And so here I'm thinking of things like e-signatures and so forth. And then beyond that, anything that at the state level that can be done to, in a coordinated way, reduce complexity for lenders and, get at sort of consistent approaches to solutions across the nation. As you know, many lenders operate in more than one state, and so the varying laws and regulations and so forth really do introduce a level of complexity that makes it very difficult in some cases for lenders to help people to the extent they really need to.
I appreciate that, Mike. I want to personally thank the panel today. There was a lot of great information here. Thank you for your time, your expertise. The audience, I want to thank you for your time to participate in this afternoon. The archives of today's webinar will be posted on NCSL's website. To find the archive, go to www.ncsl.org, click on the COVID-19 resource page, and select the webinar title, and you can see it there on your screen. With that, again, just my personal thanks to everyone, to NCSL for setting all this up, and again, our presenters, thank you one last time to them. And with that, if there's nothing else, we'll wrap up, and everybody have a good day.